We'll get started here then. Good afternoon, everyone. My name is Audrey Maxwell. I'm the current president-elect for the Texas Society of Architects. I want to welcome everyone on behalf of the Society to our first webinar. During this unprecedented time, we're trying to bring information to you that's relevant to your practice and provides a regional outlook that maybe you're not getting at the local level. Today's webinar will provide an economic and real estate outlook for the current times. Joining us is Dr. Jim Gaines, who's the chief economist at the Real Estate Center at Texas A&M University. Dr. Gaines has over 35 years of experience in real estate research and education, urban economics, land use analysis and development, and project risk assessment. He's perfectly positioned to give us an economic outlook that's more specific to our industry, and we look forward to hearing his analysis. Dr. Gaines will give his presentation, and then we'll open the floor for Q&A. So for those of you who are not familiar with Zoom, very few now, I assume, there is a Q&A button at the bottom of your screen where you can input your questions, which we will read aloud at the end of the presentation. So now, without further ado, I'm going to turn things over to Dr. Jim Gaines. Welcome.
Welcome. Thank you. I appreciate it, and it's good to be here. This is really weird. This is about the second or third one of these that I've done, and it's kind of weird sitting in my at my kitchen table, basically. That's the reason I did the background with the Zoom, so that you didn't have to see my kitchen behind me. I thought everybody's probably been watching the news and seeing common portrayal here with the people from the coronavirus task force. I wondered what Dr. Burks looked like without her hair up in a bun, so I found a picture of her. That's her over on the left with her hair down. I just thought that was interesting. I just thought I'd get us started with a little bit of humor before we get into all the really bad news. The other thing I'd say is just how bad is all of this, and it's not good. The buzzword of the day among the economists is going to be, and it's beginning to pick, and data change daily. We just got the April 18th unemployment claim data just this morning. I've got it for you a little bit later, but I didn't have a chance to incorporate it into this slide. Texas unemployment claims doing similarly. It's greater now than 8% of the jobs, and our unemployment rate probably is approaching the 10, 11, 12%. Unemployment at the national rate level probably approaching the mid to the higher teens. And we started this whole process with about a 4% unemployment rate, and we've had nearly 18% of the people working file for unemployment. Now, the reason it won't be additive is because not everybody files for unemployment counted in the labor force, so the statistics change just slightly. Housing starts, construction, something of interest, I'm sure, to the architects and that are with us today. Starts are down about 22% month to month from February to March. Still actually positive on a year-over-year basis, but that's because March is going to be the last of our good data. Good in the sense that showing positive gains of any kind. We're still showing starts on a year-over-year basis up a little over 1%. Permits up a little over 5%, even though from February to March, about the first half of March was a pretty month, and then the second half, just things started falling apart. The first quarter of the year is going to look okay. It'll be interesting to see whether GDP and some of the other measures wind up totally negative for the quarter. I can tell you that this worst on record buzzword is going to start to apply during the second quarter. April, May, and June are going to be some really tough months. March in Houston, Texas, home sales are up year over year. March home sales were actually down a little bit from February, but they were up year over year. Prices were still up. We're still seeing that. recent oil prices, not only less than $10 a barrel, that's the consistent price. But as we all know here, not too many days ago on Tuesday, the spot price actually went down negative, almost $35, $40 because of futures tradings going on. We got reports just this morning on how much oil storage there is going around the world. One of the interesting thing I saw was on the very large oil tankers. There's a fleet of about 800 of them, and about 200 of that fleet are being used simply as storage. They've been leased, and they hold something like 2 million barrels apiece or more. But the other interesting part is that the charge for that, the rent on those vessels, has increased from about $20,000 a day to $200,000 a day to store the oil in. That could have a hit us too. So the real oil, we'll talk a little bit about that as we go forward. Somewhere near 4 million mortgages are in forbearance. Again, data change on a regular basis. It's close to 7% of all the mortgages around. This is going to be an interesting phenomenon where the DSEs, FHA, VA, and other major players in the mortgage market are not going to engage in foreclosures, but are engaging in forbearance and have said to do forbearance. There's a domino effect. If you don't make your mortgage payment, that's fine. And if you're given some forbearance on not making that mortgage payment for a month or two, that's okay for you as the borrower. The problem is that the agency that collects your money has to forward it to whoever made the loan, and they're on the hook for having to make that payment. That's the mortgage servicers. And you may know, if you've been, the FHFA just came out this week and have put a lid or a limit on how far back the mortgage servicers have. They're only going to be required to make 4 months worth of payment. Even that's going to be hard, but we'll have to see how that works out in terms of how easy mortgages become when we try to get out of some of all this. Here's U.S. unemployment, the change for the month of March came in. The trouble is the way they collect the data is basically only covered through about the first half of the month, so it doesn't really capture the full impact. Here's the weekly unemployment claim. I gave you about a year and a half's history, just so you can see the series of dark bars going across there back to January of 2019. You can see how consistent those weekly unemployment claims are in the 250,000 plus or minus range. In March 7th, March 14th, were quote unquote normal weeks for claims for unemployment. And then it hit. And boy, has it hit. We've had over almost 26.5 million claims for unemployment insurance in roughly a month, in 5 weeks, as you can see. Maybe some good news. April 18th, the April 11th and 18th do show a little bit of a trend of falling off. Maybe saw a peak, but it's peaking at such an extraordinarily high level. I mean, it's more or less out in the stratosphere right now for unemployment claims. And I'm just going to jump ahead to, recovery issue of our economy is a matter of, when it's going to happen, but also are 26.5 people going to come back to work for jobs available for them when things start relaxing and as businesses reopen, those that can reopen and hire and bring people back and so forth. That's going to be the big going forward. It ain't over yet in terms of the federal funding for some of this. For the this was the we know there's another batch of money, if you will, that just got approved this week. to extend the PPP and the small business protection, another 400 billion in round numbers that's going to add to this. So you kind of get a perspective here in terms of how much federal involvement there's going to be. And the operative words down here, it ain't over yet. They're gonna. My guess is we'll go out to, what are we, phase 4, and probably going to be a 5 and a 6. One of them, though, made and we were looking at this morning. The president has said that he would like to get an infrastructure piece involved in this, and it may be reminiscent of the WPA or whatever, but anyway, to gear up on the public sector work and construction activity and spending to get going. I was watching the morning news this morning. They did a report how a lot of areas are now doing some of their highway repairs and road repairs because there's no traffic, which makes a lot of sense. Actually, they're doing it here in College Station Prime. They're reading Highway 6 for those of you that are familiar with the area here in town. And they just repaved it about 2 years ago, and they're doing it again. But at least no traffic on the road. One of the two key items that we're going to be watching is going to be jobs. We talked about that, but then spending. Consumers are the big chunk of spending. Spending generally falls into 3 categories. Consumer spending, that's you and I spending our money. Business spending, investment, and then of course government spending. Well, we are already seeing the government spending really picking up, but we'll be watching the consumer. And again, the data here lag behind. So there's a slight trend downward. It fell almost 10% in March. I suspect, and most of the experts, economists that are watching this suspect, April and May, April in particular, the consumer optimism will fall fall pretty close, pretty far. May will be interesting. If we do start the phased or staged recovery that's being talked about, not only here in Texas, but around the country, it'll be interesting to see whether or not consumers really come back into the marketplace and spend their money. First of all, they're going to have money to spend. Secondly, they're going to have the willingness to spend it. That is going to probably take time. That's the reason why when I jump ahead, I'm jumping ahead of myself a little bit, but when we get more into talking about recovery, it is not as likely to be a real V bounce back, immediate bounce back in the economy that a lot of people would actually hope for and are talking about. Retail sales, this is what I'm talking about. Retail sales plummeted by 8.7% in March, and that probably is going to go on down a great deal. And you can see how the change in retail sales, you know, it's been really basically hovering between 0 to 2%, and it does dip down every so often. But this is a dramatic, I guess in the vernacular, this is falling off the cliff in terms of the decline in retail sales. And that's what we're looking for in terms of consumption, personal consumption expenditures to come back up again. And we'll have to see how that's going to go on. Small businesses, of course, you might well suspect a big decline in that, down almost 8% from February. That's probably going to continue. The PPP, the Payroll Protection Program, that's the small business incentive program to try to keep small businesses afloat and keep their employees on the payrolls. That has so far had very mixed to negative results because of difficulty of getting money out, the amount of money, the distribution money to small businesses and so forth. I'm sure some of you are probably even more familiar with that than I am if you're in a small business and have tried to apply for the bank loan to get the funding to help cover the cost. Also, as you well know, a lot of those lost jobs and the unemployment claims, the vast majority were coming from some of the lowest paid hourly workers, hotels, restaurants, service industry employees, and so forth. And many of those, they actually make more money by going on unemployment and then filing for the extra $600 a week in unemployment or insurance on from the federal government, to where they're actually going to make more money by not working than they will by staying on a payroll. So that's going to also be interesting to see how anxious they will be to come back to work. I understand that the extra payout of the $600 is, I think it has a 4-month limit on it, but nevertheless, it's going to be interesting to see how that plays out, of how anxious that segment of labor organization is going to be for coming back. Interest rates are going to be of some interest to a lot of people. Clearly, the Fed has already done everything it can do on interest rates. It's down effectively a zero interest rate. Technically, it goes at 0.25% effective rate. That's that green line there across the bottom. That's the federal funds rate. What you can see is that the 10-year Treasury rate has declined to under 1%. I looked it up a little while ago. It's like 0.6%, which is historical low for that. The 30-year fixed mortgage rate for mortgage loans has been a little bit stickier in terms of coming down. Traditionally, it follows the 10-year Treasury rate very closely with a spread of about 170 plus or minus basis points. What we can see is, though, that fixed mortgage rate it's hovering right around 3.3% the last I looked at it, which is pretty much the historic low. I suspect it'll probably go a little bit lower in the coming 60 days. We'll have to see how that works. The lenders are a little reluctant to lower that rate for a couple of reasons. Number one, they're becoming very much more risk conscious, and so they're making they're not making the kinds of loans that might be higher risk. In other words, higher loan to value ratios, maybe to borrowers with lower FICO scores and that sort of thing. And that's also affecting a lot of the new development that will come about. Real estate, of course, has always been viewed by the regulators on the banks and the lending institutions as being high risk loans. And so they are going to be making, quite frankly, very much like they did after the Great Recession. They're going to revert back to making what I call vanilla loans. They're just not going to be making some of those loans. A couple of other things are affect that. We'll talk about that in a minute. Here's something I thought you might be interested in. This is the International Monetary Fund, the IMF, their projection on global economic growth 2020 and then 2021. This was completely revised here just a few weeks ago. And what you can see is that they're looking now for a global recession, negative 3%. They're looking at the US, our GDP to decline by roughly 6% this year after increasing about 2.3% last year. And then what you'll notice out on the 2021 column, everything turns positive. So they're looking for 2020 to bear the brunt, to be virtually a global downturn, but then to have some bounce back on into 2021. Incidentally, I can tell you for the United States, for example, the negative 5.9 or call it 6%, I'm always fascinated that economists think that they're good enough to project things down to decimal points. Anyway, I can tell you that in January, when they first released their outlook for 2020, the US projection was a positive 2%. Slower than the last year, but still nevertheless a positive, and at 2%, more or less just slightly below what we've been averaging about the last 7 or 8 years. So to go from a positive 2% to a negative 6% is a humongous decline in just a matter of weeks in terms of projections. The other thing I would point out to you, that if we do decline by roughly 6%, and if we do increase in 2021 by roughly 5%, we won't break even. If you decline by 6%, you've got to increase pretty close to 10% to 11% just to break even the next year because of the way the arithmetic of gains and losses work going up and down. A couple of other things I point out. Obviously, Europe is forecast to do even worse than the America. And then the emerging markets, the negative 1% across the board. Very low rates of growth for China, India, negative for Russia, Brazil, negative 5%. Those are kind of critical and make some impact for Texas as well, because most of the growth in the demand for oil has come from those emerging markets there on the bottom panel of this slide. And if they are not growing and not expanding their demand for oil, we're going to see that this price of oil is not going to expand or come back up anytime soon. These numbers, particularly for like China, 1.2%, while it's still positive, that's effectively a negative rate because China has been growing considerably faster than that. And to have that kind of a fall off is a considerable fall off, and India as well. Of course, those are the two most populous countries. Here's, I also thought you'd like to see what second quarter, the so-called experts around the country here are projecting. And what you can see is nobody knows is the answer. And there's a great deal of disagreement from Bloomberg at -9% to Evercore ISI at -50. It averages out about a 30%. The expected change in GDP second quarter of this year is on average of these, at least these, and you can take your pick of who you like the best, but it's around 30% decline, and that's not going to be real surprising if we hit something like that. But again, the big problem there is if you go down to 30%, you got to bounce back by almost 60% just to come back to even. So the second quarter is going to be that worst on record. We've not had quarters like that before, even during the Great Depression of the 30s. The difference here is the Great Depression of the 30s took about a year and a half for a lot of the negative influences to hit and the measures and the levels of unemployment and so forth. It was spaced out over time. This is all hitting within a matter of about 60 days. So when we've had basically a government mandated recession is what we've got. And with the stay at home, shelter in place, close your business, stop work, except for those who can work as we're doing by telecommunications and so forth. You've got to expect this kind of decline and the kinds of job losses. And it's the bounce back factor. What we're going to be looking at in historical terms, a year or two or three, when we turn around and look backwards, we're going to look at 2020 as being the big dip, and particularly the second quarter of 2020 being the big dip. I heard that phrase earlier today, so I thought I'd share it with you. You can regale your friends and neighbors whenever you get a chance to talk to them with new phrases. Economic forecasts. Here's the results of the Wall Street Journal survey. They do a regular monthly survey of about 60 economists around the country. Of course, it's always dangerous if all 60 agree on anything. That generally means they're completely wrong. But those 60 economists, they averaged second quarter of 20 a negative 25.3%. But you can see the range was very similar to the table I just showed you, from negative 7.5 to negative 42. Interestingly, nobody said positive. It's just a matter of negative. And of course, that's been the key economic question here for the last month or so. Two questions: how deep will the decline go, and how long will it last? And then, of course, the lead-on question, or the follow-up question to all of that, would be how long is it going to take to come back? If the second quarter goes down about 25%, it was interesting, though, that these same 60 economists thought that the third quarter of the year would show a positive 6%. There was again a range, and the range here does go from negative to positive. There was obviously some very optimistic economists in the group. It'll be interesting, but even at that, a 6%, even if that were to come to pass, increased third quarter would not be enough to pick us up from the second quarter. June price oil, probably in the 12.5 to $35 range. That was their projection. It looks like it's going to be closer to that 12.5 number. Job creation for the year, anywhere from positive 500 to negative 2.7. That's going to be, again, a function of, as we go into recovery mode during, and let's at least say the second half of the year, it's going to be a matter of how substantial and how quickly all these job losses that we're seeing are going to be reinstated and refilled, and people going back to work. Home prices, for those of you interested, probably going to go up maybe 1% this year. We entered the year with a shortage of housing. For those of you who are in the housing sector, you know that. You know that in the last, since the Great Recession, we have not built enough houses to actually keep up with demand, particularly here in Texas. So that will be interesting to see how that plays out. And you can see the range of expectations on housing prices. Housing starts probably going to be around that 1.12 million, somewhere in there. CPI. Inflation doesn't appear to be a big issue at this point. In fact, right now, most of the economists that we're talking to and having discussions with are much more concerned with deflation, with prices declining. We know that probably is happening. We know this price, for example, with the price of oil. We know the price of gasoline at the pump has gone down, which actually most of us who drive a car, when we can drive, appreciate, but we don't know how long that's going to last. But we'll have to see. And again, that's going to hinge on the consumer coming back to the market and buying some things. Auto sales, auto and truck sales are way down. Basic retail sales, I showed you the graph there just a little while ago, down almost 9%. If that doesn't turn around, and it's going to get worse in April, then it's going to be May, June, July, we're going to have to start looking for and seeing how much recovery we get on that to see what it's going to do and what impact it's going to have on overall consumer prices. Probability of recession in April is almost 100%. I can tell you it is 100%. We're in a recession. We're in a mandated recession. We're going to have negative GDP growth. A lot of economists tend to go with the technical definition of 2 consecutive quarters of negative GDP growth define a recession. That's an arbitrary and technical definition. When you've got unemployment, what we're looking at, when you've got decline in prices, when you've got the kind of economic issues we're facing with right now, we are in a recession. The question is, how long will it last? How deep will it go? Short term, long term, medium term, the recovery, what it's going to look like, again, I can't say it enough, jobs and spending are going to dictate the pace of recovery. It's going to happen in stages. Short term, 2 to 6 months. We're seeing that play out here politically. As I understand it, Governor Abbott came on this morning and said that for Texas that we'll start trying to do things county by county, that some counties may be the shelter in place and stay at home orders might be lifted earlier in some counties versus other counties, depending on the illness reports and infectation and deaths and so forth. So short term, 2 to 6 months, and then medium term to 6 months to 12 months, and then longer run 1 to 2 years. There's a lot of speculation that coming out of this, we could actually wind up a couple of years from now being extremely strong. That's one school of thought. Another school of thought is that the whole recovery might take as long as 2 years. At this point, your guess right now is almost as good as anybody else's, including all those so-called expert economists. We have the discussion, we're going to have a V shape versus a U, an L, which is a long term spread out, or W-shaped. And the W-shaped is concerned because if and as we start opening things up and stores open and people move around and start meeting together, even in small groups, doesn't have to be going to the football games, which is a big issue. But are we going to have a second round of the virus hit and have to go through this again? I think most every expert would agree we'd rather not have to go through that. Even if we have to prolong the shutdown, and that's what I'm calling it here, the shelter in place and stay at home. Even if we had to prolong that a week or two to keep from having a reinfection, might be economically better. That's a tough call. I'm glad I'm not the one who has to make it. Job recovery by industry segments will be uneven. Reading a report here today, hotels are going to be hard hit. Even when they're allowed to reopen and take back guests, who's going to go somewhere and want to go stay in a hotel? And then, are they going to be able to rehire their employees, their service employees, the service crews and so forth? Where are they going to be? The hospitality group, the restaurants and hospitality, the bars, even when they reopen, are they going to be forced to reopen at a fraction of their capacities? Are people really going to want to go to a restaurant and eat where it's full of other people? Who knows? Just don't have an idea for that. Good news here for some of us in the real estate field is that housing could be a leader. As you know, that construction and housing and commercial construction was deemed an essential service, so really hasn't been shut down, but it has slowed down. Low interest rates could help boost the recovery in housing. We have seen that the housing market has not totally stopped. There's a lot of closings going on without being in person, remote notarization, and Texas is a state that has the remote notarization and so on. So housing could be a leader, particularly if we could pick back up and start building homes again. We'll have to see. Let me get to Texas specifically. It's really too soon to really know or to tell about our future, exactly where we're going and how it's going to work out. Relatively speaking, U.S. has done well. Texas has actually not been hit anywhere near as hard as some of the states that we keep hearing on the news every day. Obviously not nearly as hard as New York, New Jersey, Connecticut, and up through there, even California. When you compare what's happened to us and put it on a per capita or per million, in this case per million is what that is, population. In terms of cases and deaths, we rank 38th and 40th. And these numbers are now dated. I pulled them off a few days ago, so obviously it changes on a day-to-day basis. But I think the relative ranking of where we are, and that's one of the reasons why Texas is being looked at as one of the few big states, if you will, that might have some basis for early reopening and so forth. Obviously, a limiting factor there is we also don't have the same rate of testing for the virus going on. So, and I don't pretend to be the healthcare expert. I'm just repeating to you, obviously, what's being reported by others. But you can see that we've been, I don't know, lucky is perhaps the better word, that we just simply haven't had the kind of impact. And it was projected that Texas's impact on the virus was probably going to be somewhere around April 1920. We're now several days beyond that. Whether that really holds up and stays true or not, we'll have to wait and see. We'll only know that with hindsight, but if that's true, then hopefully we're on at least the downslope of the so-called curve that everybody's been trying to flatten. Here's what weekly unemployment claims in Texas look like. We've had almost 1.2 million people, a little over actually, about 10% of the total jobs that have filed in the last 5 weeks for unemployment. The official March data was that we lost 50,900 jobs with a 4.7% unemployment rate. Those numbers are obviously not going to stay on there because the numbers are too big here in terms of the weekly numbers. When you're running generally anywhere from 12 to 18,000 job unemployment claims a week, and you jump up into the 200s and 300s, you obviously are going to have some unemployment issues. And again, just as with the federal level, it will depend on how fast and at what rate these jobs reopen and become available again. The Dallas Fed's Texas Leading Economic Index, you can see plunged about 12% in March from February. I can tell you without a doubt, the April number will be even more than that, mainly because three of the leading variables in the economic leading index that Fed does, 3 of them are energy and oil and gas related. So, and that sector, of course, has been hit pretty hard here lately. Speaking of which, you can see on a weekly basis, it went down to $19.44. The negative price that made the news so much was a daily kind of thing, but we're still running right now. Right around, I saw it this morning, it was about $16 and some odd cents per barrel. It's going to stay down in that range. And of course, with everything that's being stored and the storage capacity, this is a demand phenomenon. It isn't going to matter whether Russia and Saudi Arabia cut their production another million barrels a day or another 2 million barrels a day. It doesn't matter when the demand has fallen nearly 6 to 7 million barrels a day. So we're going to be in an oversupply situation because the demand has just simply disappeared. If and when that demand comes back, then we will start seeing the pressure come back, and the rig count will probably go significantly below where it is now. These are Texas rigs, incidentally, not US. Here's, for example, from EIA, the Energy Information Agency, the implied gasoline demand. I saw data this morning from Tech that indicated around the state, round numbers, the amount of travel going on and amount of people on the road, if you will, miles traveled and trips and so forth, is down about 45% just this last week. And it's been that way. It's been down anywhere from 35 to 50% each week for the last several weeks. So, there's just nobody out on the road. We're not doing it. The Texas recovery is going to look something, it's going to be staged and phased. We're obviously the political leadership, the governor's office and so forth, trying to figure this out. It's the only thing that really does make sense. It's not something you just flip the switch and tell everybody to go back and do what you were doing and so forth. Job recovery is going to be job recovery and consumer attitudes and spending. I think I've said it now 4 times. I was a college professor for about 14 years. I did learn you had to say, if something you really wanted to get across, you had to say it 6 times. So I'm working on that. Businesses, it's going to be a bloodbath in some sense because so many small businesses are simply not going to come back. They may have shaky capitalization. There's several studies out on the percentage of businesses that had capital that could afford to be out of business for 1 month, 3 months. Most small businesses simply don't have that kind of capital resources. Even a lot of medium and large companies don't have those kinds of resources to stay viable for any real period of time. So we'll have to see how many come back. The other thing, though, that maybe is going to get lost in the shuffle here is going to be the entrepreneurial nature. Some people who might have gone out of business may try to find a way to get back into business and just basically start over, with or without having to declare formal bankruptcy. We'll have to see how all that plays out. One of the industries, though, that's going to see a lot of that is the energy market. We're going to see a lot of the independent drillers, the independent E&P companies probably won't be able to survive. The pricing of oil on a per barrel basis is not going to be conducive to that. We're going to see some consolidation. We're going to see mergers, acquisitions going on. This is going to be and actually it has already started. A lot of jobs had already been lost in that particular segment of the economy here in Texas. It started before the virus actually hit, so we'll have to see. Again, housing, we think, should rebound reasonably well, and that's, you know, reasonably well. You can define that as well as I can, but we're thinking that there's going to be some pent-up demand. We know interest rates are going to be very attractive. We know that people who need to sell their homes, as opposed to have to, as opposed to want to, will come back, and the demand will come back as well. The issue might be if prices are going to maintain, maybe even decline slightly, or at least not increase at the same pace at which they've increased the past several years. But again, we entered all of this time with a housing shortage relative to the demand, which generally results in higher home prices. So we'll have to see. From a construction standpoint, obviously, home builders are going to be constrained somewhat in doing too many spec homes until they see how the market's going to go. I can tell you they just came out this morning with new home sales, and existing home sales report came out from the Census Bureau this morning. They were down nationally about 22%, if I recall correctly. We'll have to see. That's not to be unexpected, but we'll have to see. That's the kind of thing that could have a V-shaped recovery, in the sense that it could bounce back reasonably fast. If it doesn't, it is going to slow down and inhibit the overall economic recovery, because as we all know, building new things, new houses or new commercial structure or infrastructure development has a significant multiplier effect into the economy. It's one of those areas, particularly one of those industries, construction in general, that we'd like to see come back. The last I've got here is that local government's going to get hit hard. I saw this morning, like I say, these things change daily, and we're getting new data regularly, and today was a big news day for some of the data nerds like me around. I saw one estimate that Texas, for example, stands to have tax revenues decline between 10 and 15% a month for as long as this goes. So if it's going to take us 2 or 3 or 4 months to get out of this, we can see statewide and local government revenues, sales taxes, oil value revenue, tax revenue, vehicle registration, motor fuel taxes, all of these things that go into to fund local governments, including local property taxes, could get hit very hard and start having impact on employment at the local government level, and as well as services being able to be provided. So this is something that has kind of gone under the radar here recently, but maybe we need to be thinking about it. Let me talk about housing specifically. This was last year, 2019 was a record year. This is for Texas across the board. You can see the 2020 numbers over there in the purple. Those were our original projections back in January and February. All of that goes out the window. But you can see that 2019 was pretty good. Here's March data. These are year-over-year percent changes. And what I've got here is that I think March is going to be the last of the good months for housing for at least a while. When we get the April numbers, which won't be until somewhere about the 8th, 9th, or 10th of May, these numbers, especially the sales and the listings and activity, probably won't be nearly as good. You can see actually DFW was negative 0.5 is break even. It's just flat. But one of the numbers, excuse me, that sticks out is the active listings were starting to decline in March, of people deciding even if they had their house listed for sale, maybe taking it off of the listing or putting it into inactive, or at least telling their realtor, hey, I want to hold off and wait until all of this is over. So we're seeing that active listing count come down, and so far into April, I suspect that the same kind of thing is going on here this month as well. In the housing market, the Fed is trying to provide liquidity by buying mortgage-backed securities. They did that during the Great Recession back in 08, 09, 10, and 11. And so that'll help. They are looking at how to, quote unquote, bail out the mortgage servicers. I mentioned that a little bit earlier, because if they don't, we'll have the mortgage servicers all of a sudden also going out of business because they can't make their commitments. And then if they don't make their commitments, the bond holders are, the bonds could theoretically go into default. So it's a series of dominoes there. And one of the reasons for the Fed trying to provide liquidity and then putting some limits in here is to try to figure out a way to put a block on all of those dominoes flipping over and falling over one after the other. One of the interesting issues we've been thinking about is whether or not tenants, and this may even apply to homeowners, may take advantage of not paying rent here during the pandemic, and how that is going to affect the NOI for the multifamily housing market and the apartment market. Preliminary reports are that it hasn't been as bad as what some had imagined that it could be. Rent levels, rent collections, I should say, for the first half of April appeared to be running at about 80 to 85%. So somewhere between 15, 20% of the tenants weren't paying the rent. There was a big danger, or at least a fear, that it could be worse than that. That still is going to be an impact on the apartment market. It is probably going to be a disincentive for any new development projects being developed, and some that might have already even had groundbreaking might even decide to stop or slow down or postpone their project. And if it was still just in the planning or development stage, and as architects, this will affect you a great deal, may also be trying to put these on the shelf, at least in the short run. Again, goes back to that short run, medium run, long-term way of recovering here. One of the interesting things that's happened is the iBuyers, the instant buyers, the Zillows, the open doors, the offer pads, and so forth, virtually out of the market and laying off people. Their whole business model was based on algorithms that they could use to figure out how to price properties that they wanted to buy, and their algorithms now don't work anymore, so they don't know how to price properties that they want to buy. Plus the fact these institutions, the Zillows and so forth, tended to be very highly leveraged. They were basically borrowing and buying, and borrowing short and buying long. So they've been kind of knocked out of the market here. We'll have to see how that works out in terms of how well or how they come back. I mentioned to you before, home starts were down about 22% for the month of March, and the housing market index that puts out, that Wells Fargo NAHB, this is an Optimism index. They actually measure by 6 different things, but the overall attitude of home builders around the country, you can see, has had a tremendous fall off, again, kind of falling off the cliff. And the housing start number, the orange line there, is going to no doubt follow suit if the home builders are losing confidence or not. It's a diffusion index. If it's below 50, it means it's a bad market or not optimistic. Actually, mortgage and the mortgage market, the refi we're up about 173%. That's because of the low interest rates, people trying to refinance their homes. New loan applications were down about 26%. One of the reports we're getting, a lot of the mortgage companies, the lenders, simply don't have capacity to handle some of the the tsunami of refi apps that came into them. And that was another reason why they didn't lower interest rates quicker or as they could, because they simply don't have the capacity to process all the applications. If it's a bank directly, the banks are also being swamped by the small business loans requests, and they also are having a real staffing problem. Homes are being delisted, credit overlays by lenders is creating a tighter lending market for the home market. One of the things that's been overlooked has been appraisals and inspections. It's really difficult. Appraisers now basically don't go into the house. And while it's not illegal to do the drive-by, the windshield appraisal, or the outside appraisal, most lenders and others don't have as much confidence in the accuracy of those kind of appraisals. And now the GSEs, Fannie Mae, Freddie Mac, Ginnie Mae, so on, are allowing homes to be financed and loans to be made with appraisals and inspections being deferred for up to 120 days. But the lenders who are actually making these loans are real nervous about that and are hesitant to make it because they're afraid that 120 days from now, the appraisal, when it finally comes in, could be for far less than what they're currently thinking. And instead of making a 90% loan, it turns out they're making a 110% loan. And they're very nervous about that. The inspections, of course, is a big problem. And then, of course, any loan greater than 80% would need mortgage protection, mortgage insurance protection. And without the appraisal and the inspections, the PMI companies don't want to issue the PMI policy. So let's see how all those are coming on. In construction, a lot of owners it's reported, are increasingly halting projects and canceling some scheduled starts until they have a better feel for what the economy is going to do and what is happening, especially in their local market. Now, this is at a national level. Here in Texas, we look like we're poised to do pretty well. So I don't know if projects that are being put on hold or halted today, it might be more short-term than long-term. Of course, some of them may wind up never happening. That's nothing new in the real estate field and in the development field. A lot of projects don't happen, especially when financing can't come around. The governor and the local officials are tightening some of the essential exemptions, and some of that is looking at construction specifically. We'll have to see. I don't think that's going to really be too much of an effect here. Shortages are beginning to be reported in terms of construction materials, in addition to the PPE and all of that, and the masks and ventilators, but also particularly any kind of materials and items that are needed from China, LED lighting, that kind of thing, coming in. The input of those things have slowed down, and contractors have been reporting some problems with that. Suppliers are warning of some late and canceled deliveries, that kind of thing. And then we'll have to see how the layoffs go as these projects are either finished or halted. Few positives. There have been some new projects, healthcare, manufacturing, some other things. The warehousing, logistics space, particularly in Dallas and Houston, as things are coming into the area, they have to be stored. So the industrial market, especially the warehouse logistics real estate market, has done and held up pretty well. There's been a few cases, as I mentioned earlier, of accelerated highway and some other types of infrastructure work as traffic declines. Actually, it's a perfect time if people can get their act together and get the financing and get these projects up the way in terms of disruption on a daily basis of traffic and so forth. Obviously, substantial price reduction for fuel and other commodities, so it makes it cheaper to run equipment and heavy equipment and so forth. So that works to the benefit of that kind of activity. And then we'll have to see if there's going to be a public work stimulus program as part of one of the next phases that Congress passes on. As all of us know, Trump for several years now has been advocating $1 trillion to $2 trillion infrastructure refurbishment program and expenditure. Now might be the time to put that into play, but who knows what the Congress will do. But it'd be kind of interesting. The Mortgage Bankers Association, I was talking about the tighter credit, the credit availability index, just to go down. The forbearance, this is dated. This is now just as of about 3 weeks ago. It's now a little heavier than that. The total forbearance is up close to about 6%. So we'll have to see. The real issue is going to be how much or how many of these forborn mortgages are going to turn into foreclosures. And right now it's anybody's guess. If you'll recall back during the Great Recession, 07, 08, 09, we had something like 12 million plus foreclosures nationwide. It just decimated the housing market. I don't think we're going to run the risk of that kind of magnitude, but in some areas it could become quite problematical. Low interest rates can stimulate the housing demand and the real estate demand, but only if the jobs come back. We're going to see considerable changes. For example, I can, for architects, start thinking in terms of, I read reports from 2 different architectural firms within the last week that are already trying to anticipate changes in designs, for example, for office space, how many enclosures, open space, the basic calculus of how much space per employee do offices really have? How much more teleworking are we going to have in the future that may reduce the demand for total office space? We'll just have to see how all that is running. And what all of this is going to be a function. Retail space is going to change. The nature of retailing, the amount of space, the amount of storage space and so forth is going to happen, and we'll have to see. We'll have to see if home construction becomes the prime recovery activity. It could be, it needs to be. We'll look forward to that, because it still follows that people have to live somewhere. We all have to be somewhere. And occupancy rates are going to maintain. We'll have to see how the rents do. And Audrey, I know I ran a little longer than what I told you, but I get verbal.
No, thank you very much. So you were cutting out a little bit in the beginning. I apologize to everyone for that. We're kind of at the mercy of our internet services here. The Q&A panel is open, and Jim, if you have time to hang on for another maybe 10 minutes, we can take a couple of questions. And those of you who need to bail out, feel free to do so. Yumi had a question about how the current economic trends are impacting construction, specifically a question about schedules, prices, and material availability. I think you touched on that mostly, but if you wanted to add anything, Jim.
I'm sorry, I didn't hear all of that.
One of the questions was about how the current economic trends are going to impact construction. And specifically, it was about pricing and material availability, which I believe you touched on.
Yeah, I touched on some of those subjects. The honest answer is we don't know yet exactly how it's going to affect construction. Materials we already know are being affected from deliveries, particularly for anything coming from China or Asia, which, you know, depending on what is being constructed and the materials being used could be. Some of the other producers, manufacturers, lumber, for example, might go through a temporary period of unavailability. We're hoping, and that's all I can tell you is hope right now. We're hoping that the construction overall, not only housing, but commercial construction, public construction, infrastructure construction, will be one of the leaders coming out, and that will be incentivized to the extent possible. And because it could be a major leader in the overall economic recovery. It's going to be a mutual symbiotic relationship. The economy has to recover for construction to recover. Construction needs to recover some for the economy to recover.
Great. And so then Richard had a question about basically saying, what kind of forecast do you see in the repatriation of manufacturing post-COVID-19?
I think most of that will come back. It'll be spotty at first, and it'll depend on what it is, the individual components, what's being manufactured. For example, if the energy industry stays down, we're going to see some. It's going to be a little slower for that component of manufacturing in Texas that's related to the energy sector, which incidentally is somewhere around 30% to 35% of all of the manufacturing in Texas is related to energy. So some of this is going to be interrelated. How fast, for example, the automobile industry recovers to manufacture parts and so forth for automobiles. Air traffic, Fort Worth will be looking at that. If the government is going to come back and do more military spending. So a lot of these, all I can tell you right now is it kind of depends on which segment of you're talking about and who's going to do what and what gets incentivized more quickly than others. And then if we have the jobs come back.
Okay, and so Greg has a question about the demographics of Texas. He's saying we're basically a young, air quotes, young state, and isn't there a certain amount of growth inherent in that?
Absolutely, and Greg is exactly right. Texas has a median age of 34.9 years, and that's the third youngest in the country. We actually at the state level. The biggest generational group is not the boomers and it's not the millennials. It's the Gen Z. Is actually now the 0 to 19-year-old age group is the largest age group in Texas, which also presents a problem on our educational system. I was talking about how the government sectors and education is, the public education is going to be, in my opinion, one of the most important segments of our economy and our society that we need to pay attention to. And it's going to be very, very interesting. Our young people, a young state, we've attracted young people to move here. We've had a fairly high incidence of births over deaths. Mainly, I'm happy to report because the older people, boomers, are living longer, which I'm happy to report, being a boomer. But yes, the younger component is a significant thing, and young people tend to like to spend money. So we want that consumption to come back.
Great. All right, another question from Richard. He's asking if you think U.S. manufacturing will begin to take over any of the manufacturing that we currently depend on from foreign providers such as China.
Question. It's an excellent question. You can see that there's sort of a slight movement to that way. I mean, we've been having the trade wars and tariffs and import fees and so forth for the last 3 years. So this hadn't really had that much to do with the virus until just the last month or so. There has been a systemic move toward trying to repatriate some of the jobs back to the U.S. that left. Could this accelerate that? I suppose it sure could. Obviously, what has got a lot of attention here with the spread and the pandemic has been travel. The international travel was one of those things that hit. And if that becomes one of those things that changes fundamentally, it just reduces in international travel, especially coming here, or we allow it and so forth, it could happen. It could happen. That'll even out over time.
Okay, and then we've also been seeing, this is also a Richard question, we've also been seeing an annual construction cost inflation of about 3 to 4%, and he's asking what you see that to be moving forward.
Oh, 3 to 4% on what?
Construction cost inflation.
Oh, yeah. Oh, yeah. Right now, a lot of that inflation was labor, some materials. Right now, the labor issue is to be determined. If we have all these people unemployed and all of a sudden construction picks back up, can we employ them and re-employ them? And there, as everybody here in this audience knows, it's not the sheer number of people unemployed, it's the quality of the labor. It's the skills, skill sets, the number of people who can actually do what you would like to hire them to do. So we'll have to see how that works out. Material cost, probably in the short run, and by short run, during the course of the next 6 to 12 months, shouldn't be that big of a problem, I don't think. That's going to be problematic. I mean, I don't know what the cost of concrete's going to do. If we go into a big infrastructure development where we got to have a lot of concrete, then all of a sudden concrete becomes much more expensive. Lumber prices probably will be moderate. We'll have to see. It's a good question. I wish I had a better answer for you than I don't know, and I can tell you some of the variables here. But if construction costs going up 3 or 4% has been the standard, my guess is short run it won't go up that much, but over the course of the next year to year and a half, it probably could come back to that.
Okay, well, that's a great segue into us wrapping things up. And then I'm going to put you on the spot, Jim. We've had a question from one of our participants about whether you'd be willing to come back in a month and revisit all of these numbers with us again. And we'd love to have you.
You mean you want me to come back a month from now and tell you how wrong I was?
Yes.
Sure, give me a holler.
Great. All right, well, we really appreciate your time today. And thanks to all of you who hung in there. We will hopefully do this again soon. Thank you.
You're welcome.